Hi there, Adrian here, mortgage broker based in Sydney. On this channel we talk about all things finance, lending and investments. And on this video we're going to be focusing on the topic of financial freedom. Now what we're going to do is we're going to go through each one of these items on this list. I'm going to talk about each one of the topics, what I see as a mortgage broker and what I'm doing in my personal life and what my views on each topic are. Now let's go through the first one. So we all know that society, your parents, your family, your friends, all have common things that they say and common things that they assume that you're going to do in your life in a specific order. All right. Now, if we go through them on a higher level, so obviously when you're young, the first thing that you should be doing is getting a job and savings. And then the next thing is getting married, buy a house, make sure that it's owner occupied. Okay, try and buy in a nice area. You know, you're going to have one large home loan. It's all going to be non-deductible debt. And then a common thing that you see all around Sydney in Australia is every household has two large SUVs. Now, the minimum price of some of these SUVs new is, 40 to 50 grand. And a lot of these cars are in that kind of 80 to 120 grand bracket. So a lot of people not only get these cars, but they've got car leases, car finance, and they're on, a 5, 6, 7, 8% interest rate. All right. Now, what's the next thing that we're told? We're told to get a good job, stay in your company, work hard, and go up through the ranks and do your time. That's what we're told. We're told that you can have a good holiday every year. You deserve it. It's the Australian dream. Okay, and then we're told to save, put money into super, retire at age 65 as a good little taxpayer. Now let's go back to each one of these items and discuss at a higher level and what I'm doing in my personal life. So right now I'm age 34. I'm a mortgage broker. I run my own business. So I'm not working for a company or anyone else. I'm not on a salary. I'm not on any of that. Okay, now we're told to go and buy an owner-occupied house, put down roots and start a family. That's what I've been told by my family. That's what a lot of my friends have done. And really, if you want to look at my parents' suburb, they bought in the late 1980s, for low 200,000s when middle managers were still on, 80 to 100 to 120,000, even in the 90s. So their mortgage was only 2 to 3 times what their current income is. All right. Now, the suburb that my parents are in, you can't really even get an old brick house or a fibro house for less than $2 million. So if you put a 20% deposit on, you've got a mortgage of 1.6 million. Even if you're on, say, very high income, let's say 400,000, that's still 4 times your income. But most households are on 200,000, and some are lucky to be above that. But let's say 200,000, that mortgage is 8 times your income. All right, so you're not doing any investments, you're not putting any extra into super, you're not putting the kids through private school, you're not doing any extras or having any large holidays or anything like that. Every dollar that you've got is going towards the mortgage, and half of the lenders won't even give you borrowing power that high in the current market. All right, so what am I doing in my personal life? Well, right now I'm renting a unit, so I'm in South Sydney and I'm just about to move up to Brisbane. And in the last 24 months, all I bought is investment properties. So every one of my mortgages is deductible debt. It's not like an owner-occupied mortgage that you can't claim the interest expense and you can't claim works on the property, you can't claim property management fees, you can't claim depreciation, you can't get all these claims on it, and there's no income associated with the property. So that's all I've done for the last 24 months. All I've done is buy, as income comes in my business, it goes out into investment properties on mostly a 5 to 6% rental yield. All right, so I'm doing something exactly the opposite of that. I'm delaying gratification for my wife and I to get into a very nice property. So right now, I'm revaluing one of my properties and pulling money out and topping up my mortgage to 80% of the new value. And if that goes through this week, I'll not only be buying my fifth and sixth, which I've signed on a contract as of this week, which are two small units in Brisbane, but I'll be buying a third property, which will be a house that my wife and I were going to move into, which will be our seventh property that we're going to buy. All right, so we've rented for the period of time. We've used all the extra rental income coming in. We've structured the portfolio in a way where we put granny flats on as many of the properties as possible to increase the rental yield. And we're using that extra borrowing power to buy more properties as quickly as possible. So what our goal is, so instead of just going out and most likely I could have serviced the debt on the 1.6 million loan in my parents' suburb, but what I'm essentially going to do is get up to 10 to 12 investment properties total, get my rental income up to say 380 to 420,000 in that range at a 6% rental yield. And I'm going to have a portfolio of say 5 to 5.5 million worth of investment properties, and then each year, even conservatively at a 5% increase or uptick, a 5 million portfolio or 5.5 million is going to go up between 250 to 275,000 a year. Okay, obviously the market never goes up in a straight line, so you have some lower years, some higher years, but every one of the properties that I've purchased are in entry-level suburbs, entry-level properties, large land size with the ability to put a granny flat on the back. Very low vacancy suburbs, so less than 1% vacancy, and hold them for long term and allow them to cash flow themselves, pay themselves off. And I've got a portfolio going up tax-free over 250,000 a year. I've got income coming in of 380 to 420 a year. And obviously I've got my business income as well, which is in the top tax bracket. So I'm building a situation where, I won't say exact figures, but my income will be in the realm of 500 to 1 million a year. And at least a third of that will be tax-free. So that's what I'm looking to do. And then my wife and I will be on a plan for the next kind of 2, 3 or 4 years that when we de-risk the portfolio, pay the loan size down, we'll be in a position where we can buy the owner-occupied property. Now we're moving up to Brisbane, so if we're buying a $1.5 to $2 million property, it's almost on a waterfront suburb in the eastern suburbs, which is really nice. Obviously, my parents' properties and the area that they're in is very nice, but they're not on the water. So I can afford that 1.5 to 2 mil property, but it's fully funded based on the investments that I've made. So if anything happened in my business, I'd be able to fully fund that, still move in, still pay for it, and have rental income coming in 24/7 based on 15 to 20 tenants that I've got in my properties. So really what I'm doing compared to the majority is the exact opposite. I've delayed gratification. I've put all my money into investment properties. I've ramped that up to the maximum that I can borrow. And then I've got, a 2, 3 or 4 year plan to pay down as much of the debt as I can while hopefully the value of the properties go up. Also the rental income goes up. And then when I'm in a position where I can fully fund the end goal property, I will, and it'll be fully paid for. So this is a way that you can build wealth long term, and it ends up becoming passive because you get property managers, you get insurance brokers that do all the insurance, and you get an accountant to run all your stuff there. So you're in a position where a lot of the things that you've got going are taken care of. All right. So then we have a look at the next one, which is buying, buying two SUVs. So I've already discussed with my wife that we won't be upgrading our cars, and I drive a 2007 Suzuki Swift at the moment, and my wife drives I think a 2000 and something around that, like a 2006 Toyota Camry at the moment. We can afford all these flashy SUVs if we wanted to. We could have that straight away, but again, we've delayed gratification. We're not going to get any car loans or leases or anything like that. We're not going to have a monthly payment coming out of our account. We're not going into any credit card debt or anything like that, and we're going to be in a position where I'll run it through my business. I'll do an instant asset write-off, either next tax return or the tax return after, and the cars will be fully paid for. So that's what we're looking to do there. But again, we've delayed gratification for, well, I've been with my wife for 5 years, so by the time that we get brand new cars or something 1, 2 or 3 years old, it's going to be probably 8 years into the relationship that we've actually gotten that, and we've only gotten that at the point that we've maxed out on our residential lending. So again, we've gone the opposite of what quite a lot of people have done out there. All right, so next one. So get a job, it's safe. So let's just talk openly. My parents were part of a generation that, the middle management generation, where you could earn pretty decent money. They'd work you hard, they'd work you 50, 60 hours a week. My father worked very hard. But the income at that time in the 90s and the late 80s, for these kind of telco jobs in middle management or BDM jobs or jobs when you're in the product, you can be getting 100, 120, 130. Sure, they'd make you work quite hard, but at the end of the day, that's the amount of money that they were on. And then if you look at that job today, my father told me that one of the guys was still in that and he was just about to retire. The income's only really gone up to like I think 150, 160, and his level that he got to has turned into a general manager. At least 20 other middle managers that were on his kind of role across the business were fired. And then the direct reports under this guy ended up being, I think, over 50 employees. So they've added extra stress, extra risk, extra hours. So he doesn't work anything less than a 60 to 70 hour week. And his income's only really gone up maybe 10, 15 to 20% max over almost a 25 to 30 year period. So when they talk about get a job, do your time and go up, it's very different for people nowadays. Everyone's coming out with a uni degree. You've got all these young kids that think that they can get to middle management or product jobs or analyst jobs very quickly. But then you've got a crux of people like me that were I was in a Big Four bank. I was on a margin lending stockbroking desk. I went for I went for 4 secondments to get out of my position and to reskill and get more experience. Plus, I went for at least 5 job promotions. Didn't get any of them, even some of the roles that I've been doing for over 12 months actively and successfully. They still didn't give it to me. So it got to a point where they weren't willing to give me what my worth was, so I had to leave. So I left to the lending side of the business, the home lending side, and then I found out, look, with all my experience, I can go straight into mortgage broking. I was sitting on a divorce, splitting half of my assets 5-6 years ago when I sold my house. So I had a cash buffer under me, so I was willing to take that risk. Now, if I didn't have the cash buffer, it took 3+ years of grinding, working, networking, speaking with people to develop my skill set. It took a long time. I was always ABN during that time, but I was aligned to 3 separate businesses during those times. One was I was doing a lot of off the plan units. So I was doing a lot of that for a company called CBRE. I was in their finance arm. I was with a real estate firm, so we were doing a lot of, they sell a property, we do the pre-approval, they buy another property in the area, so we were doing a lot of that. So a local real estate agent had 3 offices in the south of Sydney, and right now I'm over 2 years running my own business. But I guess the key thing is I wouldn't be on the income that I am without taking the risk, and I wouldn't have the investment portfolio that I've got now, and I wouldn't have 3 or 4 or 5x my income unless I actually showed my worth and left and allowed me to dictate what I'm worth. So conventional wisdom of get a job, it's safe, you're not replaceable, I think it's changed a lot for the younger generation. All right, so that's that topic. It's a little bit deep, but I see a lot of people that, and you got all these kids coming out with liberal and arts degrees, and they've got 30, 40, 50 grand HECS or student debt, and they can't get a job that's 40 or 50 grand because they haven't gotten a university degree that's actually in a high paying area, like any of the STEM fields, so engineering, IT, medicine, lawyers, those accountants, those kind of ones, where the skill sets are needed, and if you work hard and you specialize, you can get your income up very high, especially in your IT contracting jobs. All right. So I just find it interesting how a lot of people, when they're young, they don't look at the degree that they're going after, and then they don't understand their income or their job prospects when they come out. So that's something I think a lot of people should be doing. And then if you enter the workforce, having a timeline and a set plan to get to your next role, or to continue leaving roles every kind of 18 to 24 months once you've gotten the most out of the role if they're not giving you the opportunity for advancement. All right, so that's the next one. Then the next one is save for a holiday every year. You deserve it. So most people, what they do is I see it so much in Sydney, they're on 80 to 120 grand each. They've got a house that's between 1 to 2 million in value. They've got a mortgage over 1.1 to 1.2 million. They've got 2 SUVs. Half of them are on car finance. They've got a couple of kids. They're living the life, but all of their money is coming in and then out of their account, and then that's it. All right, what am I doing? I'm building an investment property portfolio, and right now I don't even have a credit card. All right, but when I max out at the 10, what am I going to do? I'm going to get a 10 or 20 grand credit card limit with points on it. I'm going to funnel all of my transactions through my every investment property, so the insurance, the council rates, any works that need to be done, any purchases, and I'm going to do that over a year period, and I'm going to have a first class holiday every year for my family, and hopefully I'm trying for kids at the moment. So again, I've delayed gratification, because if I got that 20k credit card limit now, it would limit my borrowing power. But do I have a set plan to get to where I want to? Absolutely. So that's how I'm doing it, and the holiday is going to be fully paid for by the credit card, and I'm going to use the interest only period, which is 55 days, and I'm never going to pay any amount of interest on the card. So again, I'm doing things opposite to what the majority of people are doing, and I'm getting outcomes that are different from the majority of people and what they're doing. And then the last one is save. Once you've got your whole life together, once you've got everything in line, once you've got a little bit of extra income, start putting money into your super, retire at age 65 and be a good little taxpayer for your whole life. All right, if you want to look at my steps to financial freedom and you want to apply that to me, I want to be able to have the choice to retire in the next 5 years if I want to. So I'm age 34. And look, I think it'll be 2 or 3 years, but I'm just putting a 5-year timeline on it. And look, that's just not what I want to do. I don't want to grind for the rest of my life. I want the option on whether or not I want to work, how long I want to work, what I want to do, how I want to do it. Okay, look, I'm a person that always wants to be having my hands in something, so I don't think I'm going to fully retire, but I want that option. Okay, and that's what I'm doing. So a lot of people, they're just putting your standard 9.5% into super, and then half of the people don't even know what super fund they're in, and then the other half of those people that know don't even know how their super is allocated. And me, it's going to be very different. In about 12 to 18 months time, I'm going to do 3 lots of 50 grand each, because if you miss a prior period of super payment for prior years, you can catch that back up. So I can do 3 lots of 50 grand a piece, 3 lots of 50 for my wife, 3 lots of 50 for myself. So that's 300 grand total. And then I'm going to start at SMSF, and then I'm going to hire a financial planner, and then I'm going to put money into index funds and Australian listed companies. Okay, and then what I'm also going to do is I'm going to get 2 investment properties in the SMSF on 6 to 8% rental yields, and then that's what I'm going to do there. So again, I'm doing an SMSF when the majority of people are doing just normal super. Again, I'm doing the opposite. I know exactly my current balance, where it's invested, how it's invested. Most people don't know that. And again, I've got a timeline on when I'm going to start putting some money, extra money in it, how much, and what I'm going to do with that money. So I guess the key thing for this video is we've got to make sure that we're on top of these kind of things, but not just that. I've been a rent investor for the last kind of 2 to 3 years. And you've got to understand that when you go against the grain, when you do things that are different from the majority of people, you'll start getting some flack, and you'll start getting judgment from people that aren't doing what you're doing, or they judge what you're doing. And I'm getting that right now from my parents. My dad's a lot better than my mum, but mum either doesn't understand it or thinks that you've got to do life in a very specific certain way. And if I did it the way that she wanted it, I wouldn't be in the position that I am right now. Okay, friends, it's very different. You can't be very open of the amount of purchases that you're making and the amount of rent coming in, and they start seeing the disparity between what you're bringing in and what you're doing to what they're doing, and then it starts, on a micro level judgment. On another level, you can't be very open with them because they either don't understand or they're not doing the same things that you're doing. So, you can have great relationships and great friends, but you can't be open to that side of you. And I'll just be honest, that's currently what we're experiencing at the moment. So my wife and I, we're very vocal in how we discuss things with each other, but how we discuss things on an open basis with family and relationships, we keep things pretty short. So this is just a video around financial freedom, what common things we're told to do by society. And let's be completely honest, if you do what everyone is doing, you will get the same results that everyone else gets. So if you are not willing to change how you do things, you won't get the same results. And I'm not sitting here as a guy on $500,000 a year, out of my business. I'm not on anywhere close to those levels. Our income is in the top tax bracket, but it's nowhere near the massive numbers that some people think that we're buying all these properties. All right, so it is. There are a whole bunch. There's thousands of families across the country that are on over 200 grand household income that can be doing something very similar to what we're doing and really unlock their lives over the next kind of 3 to 5 years. But are they willing to do it? Are they willing to go through the the pain? Are they willing to delay the gratification now to get the end result that they want? A lot of people aren't. They're in a holding pattern in their lives. They're always looking at the thing in front of them and the next thing that they're being told, and they go through this whole list. So over here, they go through this whole list one by one, and then they don't even think about it. All right, so you see all these people on 200 grand plus household income. Income comes in, expenses go out, nothing happens. And yes, they've got a property that is worth, $1.5 million, 2 million, slowly goes up over time, and they think it's an investment. When really, if they structured their life properly, they could unlock themselves from the system within, a 3 to 5 year period. All right, so really hope that you've enjoyed this video. Please hit me a like, hit the subscribe button, and we'll see you on the next one. And leave me a comment if you can. I really appreciate if you're liking this type of content. We'll see you on the next video. All right then, bye.